Hello everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robot trading software for free. Now let's look at how to use the MACD indicator. MACD here refers to the moving average convergence divergence. Now what is the MACD indicator? So MACD is an updated price momentum indicator created by Gerald Apple, which is sometimes includes a signal or a trigger line. So this is a smooth oscillator based on the point spread difference between two exponential moving averages, also known as EMA, and this is constructed by subtracting short and long oscillators or by measuring the differences between them. So for measuring the differences, we need a 26 period exponential moving average, which is the long oscillator, and then we need a 12-week or 12 period exponential moving average, which is the short oscillator. So the difference between this short EMA and the long EMA forms the MACD line, and the 9-period exponential moving average forms the signal or the trigger line. So when we form this indicator, you have to buy when the moving average convergence divergence crosses the trigger line. So what are the features of the MACD? The MACD considers the difference between short-term and long-term exponential moving averages. It is calculated by subtracting the 26-period exponential moving average from the 12-day exponential moving average. A 9-day exponential moving average of the moving average convergence divergence is called the signal line and is then plotted on top of the MACD, functioning as a trigger for buy and sell signals. So let's look at the MACD line and the signal line. So the MACD signal line, this is a trigger line that signals buy or sell strategy. So the signal line is formed, as we mentioned, by the 9-period exponential moving average of the MACD line. When the MACD crosses the signal line from below, it is a bullish trend, and when it crosses the signal line from above, it is a bearish crossover. So how does the indicator work? The MACD crossing above zero is considered bullish, while crossing below zero is bearish. Secondly, when the MACD turns up from below zero, it is considered bullish. When it turns down from above zero, it is considered bearish. During trading ranges, the MACD will whipsaw with the fast line crossing back and forth across the signal line. Users of the MACD generally avoid trading in this situation or close positions to reduce volatility within the portfolio. Divergence between the MACD and the price action is a stronger signal when it confirms the crossover signals. So let's look at it with the image here. When the MACD line crosses from below to above the signal line, the indicator is considered bullish. So here the blue line here is the signal line, and this red line is the MACD line. So the MACD is crossing from below to above. So this is a bullish line signal. This here is a bullish signal, so this is a buy sign. And here, when the MACD crosses from above to below the signal line, the indicator is considered bearish and it's a good signal for selling. So the further above the zero line, the stronger the signal. So as we can see here, this is how the MACD indicator is used. So this here is a buy signal and this here is a sell signal. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robot trading software for free.